Okay, guys, so welcome everybody to today's webinar where we're going to be touching on, we're going to be looking at volatility analysis, risk management, and basically just making sure that you guys never, ever blow your trading account ever again. If you already have, and if you haven't, good, because after you watch this, you'll never, ever lose your trading account balance from a single trade or accumulation of a few losses, which can happen in trading. And the most important thing is you understand risk, you understand volatility, you understand how to calculate your trade size. And I'm really going to break this down with you guys because it's so important, because over the years when I first started trading, I lost so many accounts because I didn't understand the risk when I first started. And I wish someone could have told me what I didn't understand at that time, because it would save me time and money. And money is the most important thing we're trying to make when we're trading. So guys, a margin call. We all know what a margin call is. A margin call is when your broker closes all of your open trades because you have no more capital in your account to keep open the trades. Basically, you've blown your hard-earned money on a single trade, on a multiple amount of trades. And this is obviously very frustrating, can be very depressing when you're in the market, especially when you work really hard for your money. And this is the situation I want to avoid for you guys when we really dig deep into this. And there's going to be some Excel spreadsheet downloads for you guys. You can download these spreadsheets, go over the data. I'm going to show you how to update the spreadsheets yourself. And then once you have this knowledge at your arsenal and in your capability, trust me, you'll be an efficient trader and you'll be always getting in at the right price. Your stop loss will always be at the right price. You'll take profit targets. You'll always be aiming for an intelligent risk to reward that helps your account grow. And I'm going to show you how you can take 50% of your trades. Only 50% of your trades can be right, and you'll always be making money. Even if you could even have lower than 50%. You could have 30% of your trades that are only going right, and you still make a profit. So this is really important for us to understand. So I really do want to break this down for you guys and help you with this understanding. So guys, risk management. So why do people blow their trading accounts? What is the fundamental reason behind people losing enormous amounts of money on a single position or a few positions? And it's all because people are not understanding how to calculate risk when they're in a trade. Because if you do not understand how to calculate risk, it's going to become very problematic, because people don't understand that when we're looking at risk is always calculated in percentage moves, because percentage moves in the markets is what you have to understand happens historically over different time frames. If you're a day trader, if you're a weekly trader, if you're a monthly trader, you really need to understand how much does a currency pair, how much does a commodity, how much does a crypto, how much does a stock market indice fluctuate on average on a day-to-day basis, to make sure you don't get caught out by the markets. And then you then have to know in your trading account how much you're risking as a percentage to make sure that you always give yourself a good chance of making money. And then when I start to explain risk to reward to you guys as well, this will really start to make sense. And you're really going to see, once I show you this, why day trading is quite a very risky way to try to trade. When I show you the numbers, I show you the figures, you're going to automatically understand what I'm saying. And you're becoming very intelligent now when you use the spreadsheet, which I give you, to calculate your trade size, calculate where to place your stop loss, calculate where to place your take profit target based on historical volatility data, and based on all of this information I'm going to give you inside this spreadsheet. So let's say, for an example, you have a $10,000 account. I was going to go for some examples when you're risking high amounts of your account on a single trade, how many trades it takes till you basically lose your account balance when you're in the market. So let's say, for an example, guys, you have a $10,000 account, hypothetically speaking. Let's say you're risking 20% of your account per trade. Okay, so if you lose a position, you're losing $2,000 of your 10,000 account. And let's say you was aiming to try to make 6,000 per trade. So you're having a 3-to-1 risk to reward, which is a risk to reward that I always recommend when you're jumping in the markets. But what we see is, guys, when you're risking such a high amount per trade, it takes 5 trades for you to blow all of your money. Now, some people risk 25% of their account on a single trade. Some people risk all of their account on their trade because they don't understand that the market moves in percentage terms can wipe out your account so quickly if you don't understand how much, as I said, a currency pair, crypto, a commodity like gold or silver or copper or oil, for an example. You don't understand how much it fluctuates by per day. If you don't understand how to calculate your pip value, so the value of your trade every time the market moves by a single tick, or we call it pip or point, you can lose money just like that. So if you're risking 20% of your account, guys, 5 trades in the market that go against you, you've completely lost your money. Okay, now this happens to so many people at the beginning of their trading because no one teaches them risk management. They don't understand risk management. And to be fair, I don't really blame them because no one's ever explained to them how it works. And if you don't know, you don't know, and you're just caught on the wrong side of the market, and you really become a prey to brokers that pocket your losses. So this is what I really want to help you prevent. Okay, so risking high amounts of your account on a single trade, guys, really blows your account. So if you're risking 20%, you're losing $2,000 out of a $10,000 account. And look, it takes 5 trades, and your 10,000 balance has gone down to 0. Okay, now this is obviously, it doesn't have to be a $10,000 account. It could be a $2,000 account. Okay, the principle still remains the same in terms of how much you're going to lose on a single position. Okay, so let's say you're risking 20% of your account per trade, and you've got a $2,000 account. Your max loss is going to be 400, and there you go, guys. 5 trades, and you've completely lost all of your money. So risking a lot of money per trade is really going to kill you when you're getting into the markets. And again, the less you risk, the more trades it takes for you to lose your money. So if you then move to, let's say, you're risking 15% per trade, and I'm going to teach you guys how to calculate how much you're going to risk per trade to make sure you never lose. So I'm just going to go over some examples, but I will be showing you how you can choose for yourself how much percentage risk you want to take and how many trades that would take for you to lose your account. So you can start to get comfortable in terms of saying, well, if I risk this much, I know it's going to take me 15 trades, 20 trades, 30 trades in a row before I blow my money. And to be fair, if you start losing 10 trades in a row, you need to take a step back anyway and just reevaluate what you're doing, because obviously something's going wrong if you're losing so many trades at the same time. But let's have a look at an example of 15% per trade. If you're risking 15% per trade, again, with a $10,000 account example, it takes 7 losing trades in a row before you blow your account. And you're actually out of the game. It actually takes less. It actually takes 6 trades until you're out the game. But again, 6 trades, if you don't know what you're doing, especially if you're trading technical analysis where you don't really understand the fundamentals, you don't understand fundamental analysis of the macroeconomics driving the market, you don't know how a political event can drive the market, or stock markets or the bond yields, what's been happening recently on moving markets, it's easy to lose 6-7 trades because you're basically just gambling every time you're taking a trade anyway in the markets. But again, less risk, you do get more trades. Here we get 7 trades before we blow our account. You take the risk down to 10% per trade. Now you're looking at 10 trades before you lose your hard-earned money in the markets, okay? If you then go down to 5% risk, which is like the maximum I take personally, now you're looking at 20 trades until you lose your money. Remember, this is 20 trades in a row, okay? It's never really going to happen, especially when you know what you're doing. But the point that it takes a lot of trades now when you start to go down to 5% risk until you lose your account, okay? Move it down to 2% risk. It takes a lot of trades, 50 trades in a row before you lose your hard-earned money. So clearly, as investors, as traders who are trying to preserve our capital and grow our money, we are trying to always trade instruments and risk a certain amount that is not going to allow us to blow our account so easily. So we really want to be trading within the range of, say, like 2% per trade risk or 5% risk per trade, because at least we know it's going to take me between 50 or 20 trades in a row before I blow my hard-earned money, okay, in the markets. And of course, if we even get anywhere close to half of that, let's say we lost 10 trades in a row, then maybe we'd really want to step back and evaluate what's really going on in our trading, because that's a lot of money, that's a lot of trades to be losing back to back in the market. So clearly, we need to understand now, well, if we want to be using low risks in terms of percentages. How can we also make it work in our favor, where what happens if we win a trade and then we lose a trade, or we win a trade and we lose a trade? And this is where risk to reward comes into play. And risk to reward is a very good strategy in terms of winning only half of your trades, 50% of your trades, but yet your account can still grow because you're using an intelligent risk to reward. So in this example here, guys, we've gone back to the 20% risk per trade example as we had in the margin call example here. So we can see at the very first example, we had 20% risk. Now I'm going to show you how a risk to reward strategy is, even though I never recommend trading risking 20% per trade, I'm going to show you the power of only getting 50% of your trades right. Okay, only 50%, but now using a risk to reward strategy. Now, a risk to reward strategy is, if I've got a $10,000 account, let's say I was crazy and I was risking 20% per trade, which in my mind is ridiculous. What basically you want to be doing is 20% of 10,000 of a 10,000 account is I'm risking $2,000. So that's the maximum I would lose on each trade if I was risking 20%. And remember, guys, I'm going to show you how to calculate how much you'll be placing on that trade to only lose 20%. So don't worry about that. I will move on to that next. Okay. If I'm risking only 20% of the account, all right, so $2,000 of a $10,000 account, then I would aim to get $6,000 on a winning position. So my reward is 3 times greater than my risk. Okay. So think about that for a second. Every time I lose a trade, right, I lose $2,000. Every time I win a trade, I win $6,000. So what does that mean? That means the moment I win a trade, I now have to lose 3 trades in a row just to break even and go back to where I was at the beginning. So this is where risk to reward really helps you. So let's say, for an example here, we have our 10,000 account. We win our first trade. We make $6,000. Okay, because 6,000 is 20% times 3. As we looked at the example, it's 3 times greater than our potential loss. And then if we lost our next trade, we're only losing 2,000 out of that 6,000 we profited from. And if we then won the third trade, we're making another 6,000. Okay, and then if we lost the fourth one, we're only losing 2,000 of that overall 10,000 profit we've made. Okay, in the markets, you can clearly see as you go down, you could then take 10 trades, only win 5, but you've doubled your money in the markets because you've always made 3 times more than you've lost in the market. So the moment you win a trade, you have to lose 3 times in a row just to break even. Okay, now think about this. What happens if you win 3 trades in a row? Now you have to lose 9 trades in a row to break even. And I've done this I've won 7 trades in a row many times in the markets. And once you start hitting those numbers, guys, you're laughing. You're never, ever going to receive a margin call. You're never going to blow your account, because once you know what you're doing, you're never going to lose. Oh God, what's 3 times 7? You're never going to lose, 21 trades in a row after that. Okay, guys. So clearly the risk to reward really helps you in the markets. Okay. So again, let's take the risk down to 15% instead of 20. And again, we now know when we go to 15%, again, our margin call is further away. But again, you can see, guys, it really does help when you're in the market. So 15% of our 10,000 account. So if we was to risk less, then we know we're risking $1,500 out of that 10,000 account, and we're 3-to-1 risk to reward. We're aiming to make $4,500 on our trades. So obviously we're going to make less profit than we did on this situation. But remember, we're now taking less risk. So there's less of a chance of us getting a margin call, because again, when we go to the 15%, it takes 7 trades to lose our account, whereas the 20% takes 5 trades. Okay. So clearly if we take, again, 10 trades and we only win 5 trades and we lose 5 trades at 50% success rate, we still make 150% return on our money. Okay. Again, 10%, same situation I was telling you guys, less risk because it now takes 10 trades till we lose our account. And again, we got our 3-to-1 risk to reward for risking 1,000, which is 10% of 10,000. We're aiming to make 3,000. Again, we take 10 trades, less risk before we blow our account. If we ever was to lose 10 trades in a row, which I hope we don't, But again, the most important thing is what I'm trying to tell you guys is, here we go. We make 100% return on our money. 5% risk. Again, we take 10 trades. We know with a 5% risk, we have now 20 trades until we lose our account. Never going to happen. But again, the most important thing is, guys, we're making 50% return on our money. Now, you guys, I don't know if you know about hedge funds, investment banks. Go look at Warren Buffett. Go look at Ray Dalio. Go look at the biggest investors in the world. They're not making 50% per year in their returns, and they're managing billions. Okay, so it's really important for you to understand as well percentage returns, to understand how well you are actually doing when you're trading, because you may have only started trading with $2,000 and you've made a $400 return on your money, and you're thinking it's only $400, but you're not realizing you've made a massive percentage return on your account. If you could do that consistently, you would get billionaires that would throw money at you, because in your small account, it might not seem like a lot of money, but you start getting this type of returns on big accounts, you're making a massive return on your money. And that's why we have to look at percentage returns and understand how important it is to become good ethical traders in the markets and not take too much risk. Because again, if I give you 100 million of my money and I say to you, and you get me a 30% return on my money in a year, I made 30 million pounds profit in 1 year in the markets. But again, if you make a 30% return on your $2,000 account, you may not think it's a big return because it's a small amount of money, but you don't even understand in the bigger world of investing in markets, that is an enormous return on your money. So guys, I'm just trying to get you into thinking about taking lower risk. So it takes a lot more losing trades to blow your account, because we want to preserve our capital and grow it. We do not want to lose it. We do not want to be taking high risks in the market and being aggressive and making stupid mistakes. I made dumb mistakes in the past. I'm so happy that I learned from it, because now I can come in this webinar and share it with you and make sure you don't ever make the same mistakes that I made when I was trading, okay? Remember, trading is not get rich quick. It's a long-term plan. And again, guys, you're taking 2% risk out of a $10,000 account. We're risking $200. We're aiming to make $600. We're only doing 50% of our trades. We're making a 20% return on the markets. And Warren Buffett, over his whole entire career, on average, has got a 20% return. So if you can do that, guys, that is very, very important when we're trading. So the reason I was showing you 50% return is because some of the very best traders in the world who are known for being very successful, they was on average only getting around 50% of their trades right. That's an actual fact for some of the best traders in the world in the past. Okay, you can research it. Half of their trades they get right, but it's not about how many they get right. It's their intelligent risk management. It's the risk management that allows them to get these returns of maybe 15%, 20%, because their risk to reward is always helping them from these losing trades. We're all going to lose trades. We're all going to go into the market, think that our idea is very good. The market goes against you. You're going to lose your money. It happens. But if you have a risk management strategy in place where you're risking, let's say 2% per trade or 5% per trade, meaning that it's going to take you 20 trades or 50 trades until you lose your money. And then you start using this risk to reward strategy of 3-to-1. And you take, let's say 10 trades in a year, you win 5, you lose 5, but yet you're making 50% return on your money, or you're making a 20% return on your money. If you do that consistently, you're literally at the elite level of investing. I don't ever say it's not possible, because it is possible. I made amazing returns last year and this year as well already. So it can be done. And you can trade it. You can trade the markets in a professional way, in a good way, and a way that's reducing risk and helping you get rich long term as well whilst you're trading. Okay, so next up, what I want to show you guys is, now that we've run through the risk to reward spreadsheets and I've shown you these examples, I really want to show you how to now calculate your position sizes, because it's really important that we understand that when we're going to go into the market and we're going to take a trade, how do we calculate how much to place on a position, for an example. Now, before we calculate how much we're going to be placing on a trade, first of all, we need to understand how much does the commodity we're trading, like oil, gold, silver, platinum, copper, currencies, if we're looking at euro, dollar, USD, Norwegian kroner, for an example, if we're trading cryptocurrency like Bitcoin or XRP, Ripple, or if we're going to go into the markets and we're going to go and trade the US stock market indices, we need to know how much does this asset fluctuate by on a daily basis, on a weekly basis, and on a monthly basis? So when we get into the market and we're trading it, we know where to place our stop loss, and then we know where to place our 3-to-1 risk to reward take profit target, okay? And this is where this thing called the Atr Volatility Analysis is going to be your best friend. And I'm going to give you the downloads. And once you get this, I'm going to show you how to update these spreadsheets. And whenever you go into the market and you try to trade intraday, you try to trade over a weekly time frame, you try to trade over a monthly time frame, you will use these Atr Volatility spreadsheets. You'll use these, and it will tell you historically how much a currency pair like the USD Norwegian krona, which I've shown you in this example, how much does this fluctuate by per day on average? All right. How much does it fluctuate by? How much does it fluctuate by on a weekly basis per average, on a monthly basis per average? Because you need to know where to place your stop loss. And I'm going to give you some really good examples to show you that if you do not understand volatility, how you can get into the market, not even understand how much a currency pair fluctuates by per day in terms of pips, for an example, and you're going to get caught out and you're going to really lose money in the market. So as you know, when you're trading an exchange rate like the markets, each decimal point that the currency pair moves by is going to be in terms of a value. So that's going to be a monetary amount. It could be, it depends on how many lots you're trading. Okay. So I don't know if you understand lots and units. If you don't, I'm going to take a video that's actually part of my course, and I'm going to share it with you guys for you to watch after if you're trading currencies, for an example. But I just want to dive home this point to you to make you aware of this. So if you was to be a day trader, right? If you was to try to trade the US dollar, all right, for an example, and you're looking at the US dollar against the Norwegian krona, this spreadsheet here is looking at the daily returns of the US dollar Norwegian krona going back 10 years, okay? So this is going to tell you on average how much does it fluctuate by in terms of percentages, and this is all automated on the spreadsheet. So all you have to do when I show you after is download the data, and the data will automatically update, and it will show you this data in real time, how it changes over time. So you can always know where to put your stop losses, because sometimes volatility picks up and we have to move our stop losses further than what the market currently was moving before in the market. So in this example, we have USD Norwegian krona. Historically, it's telling us, for an example, over the past 5 years, on average, the volatility is 1.38%. That's how much it fluctuates by per day. All right. Now, euro dollar, so the euro against the US dollar on a day-to-day basis fluctuates historically by 0.65% per day. Okay, so let's have a look at this on the chart. Euro dollar on left, USD Norwegian krona on the right. 0.65% is how much the euro fluctuates against the US dollar. That's 77 points in the markets, all right? So 77 pips, okay? Now, look at the USD Norwegian krona. We looked at the data on that spreadsheet. It fluctuates around 1.35% of the time. This is 1,132 pips per day. So whenever you hear traders go, oh, I'm going to go into the market and try to get 200 pips. I'm a day trade the markets and make 200 pips. If you don't even understand that the US dollar Norwegian krona moves 1,132 pips in a day, you're going to get caught out. The market's going to move like that because that's how much this currency fluctuates by per day on average. Okay, the data is the data. You can't deny the data, guys. This is going back 10 years, this data. This is how much the USD against the euro fluctuates by, and this is how much the US dollar against the Norwegian krona fluctuates by every single day. That is a fact. You can't change that. That's how much it fluctuates by. So if you're trying to go into the markets and catch 200 pips on trading the US dollar Norwegian krona, you're going to lose your money automatically because it moves by 1,000 pips a day every single day. It goes up or down. And by the way, on average, it goes up just as many days as it goes down. So it's like a 50-50 coin toss if you go back and look at the data over a long period of time, okay? And Euro USD is fluctuating by 77 pips, all right? But if you don't understand volatility, if you don't understand using an Excel spreadsheet how much this currency pair when you're comparing two different exchange rates are fluctuating by, and then you try and go and trade USD Norwegian krona, you're going to get caught out. All right. Now, This is why the reason I was showing you this is because day trading, I'm going to show you how important day trading is in terms of understanding this, because remember what we spoke about, risk to reward 3-to-1 helps your account grow. You have to use that strategy. Otherwise, you can't grow your account. All right. We looked at it in the spreadsheets. I was showing you if the best traders in the world are only getting half of their trades right, or they can't be aiming to get the same amount of profit as they previously lost. Otherwise, you'll just have no money. You just always have the same balance. You have to always make more money on the winning trade than you do on the losing trade. So for an example, if euro dollar fluctuates by 0.65% per day, if I was to buy the euro against the US dollar today, for an example, my stop loss would have to be 0.65%. So from where the price is right now, if I was to try to day trade this currency pair, that would have to be where my stop loss is. For an example, if I entered the market right now, my take profit would have to be 3 times greater than my stop loss to get into the market. So I would need to have a take profit target of around 1.95%. That would be my 3-to-1 risk to reward, right? So I'd have to aim to come out the market around 1.22 in the exchange rate to get that profit, to make sure that now that I've made 3 times more profit than that potential loss, I'm comfortable now to know I have to lose 3 trades in a row before I lose that profit I just made on that previous trade. But guys, think about this. We already know that euro dollar only fluctuates by 0.65% per day. That's a fact. So how are you going to make 1.97% per day? You can't. If it only fluctuates by 0.65%, think about what I'm saying. If it fluctuates by 0.65% every day over the past 10 years or 5 years, we looked at that data, that's what it was calculating it by. If you're trying to day trade, how can you get a 1.97% return on your money in a single day if it only fluctuates by 0.65%? You can't. That's why day trading is so difficult, because you have to have the stop loss at 0.65%. You have to try to get a 3-to-1 risk reward just to grow your account, but the currency pair doesn't fluctuate by that much in a day. So really, you're going to hold this trade over maybe a week horizon. But then if you're trading over a weekly horizon, then you're going to have to know where the stop loss is on a weekly basis, not on a daily basis. Okay. And this is what I'm trying to show you guys. Let me go back to the spreadsheet just to make this point important. And guys, save your questions, because I'm going to answer all of your questions at the end. All right. So look, if I now know that I can't make that 1.95% return in a single day because it doesn't move that much in a day, well, maybe I say to myself, well then, okay, maybe it'll take a week to get there. So should I hold it for a week? Good point. But then again, the currency pair fluctuates 1.61% on a weekly basis, going back 10 years. That's the fact. That's the numbers on the spreadsheet. So then my stop loss would have to be 1.61%. That's where my stop loss have to be. And now my stop loss, if it's 1.64%, 1.64% times 3, my stop loss would have to be my take profit, would have to be 4.92%. So my stop loss would have to be up here. But now we already know that it doesn't move that much in a week. It moves that much probably in a month, which is why I'm trying to show you guys that when you trade any market, what you really want to do to make this risk to reward work in your favor is trade a trending market and use the highest time frames as your take profit or stop loss area. So like monthly charts. Don't get me wrong, guys. You can use, for an example, a weekly Atr volatility if you want to hold your trade over a few weeks, and it could go up that much in a few weeks, but historically the data is telling you it doesn't. It only moves 1.64%. So the point I'm trying to make is day trading is very difficult because you can't get those returns that you have to get the returns for in a single day to have that risk to reward working in your favor. Okay. And the point I'm trying to make is if you don't know how much a currency pair fluctuates by per day in percentage terms, as we looked at the beginning, when we looked at, for an example, the euro dollar fluctuating by 0.65%, which was 77 points, but then the Norwegian krone is moving 1,132 points in a day. You're going to get yourself into some big trouble if you don't understand how much currencies fluctuate by. And it's not just currencies, okay? I've got this data for everything. So let's say we're trading the S&P 500, okay? Let's say we're going to buy the stock market index in the United States. Let's go to our indices spreadsheets. Remember, I've got spreadsheets for everything for you guys. So you're never, ever going to be in a position where you go into a trade and you don't know where to place your stop loss on the different time frames. I'm going to show you. All right, let's say we're trading the S&P 500, okay? 8.4% is the average 1 month volatility, okay? We know that stock markets can be quite, can fluctuate quite aggressively. That's why I never trade stock markets, hardly ever short term. Sometimes I do if there's sharp movements, but usually I give it long periods of time. I use the volatility for a 1 month window because you can, if you try to do a daily stop loss or a weekly stop loss, a stock market will catch you out so quickly and you end up losing money. So for my example, 6.4% if I was trading the S&P 500. So if I'm jumping in the stock market right now for the S&P 500, I know my stop loss has to be 8.4%, which basically means my stop loss from the current price of in the markets right now would have to be around here, 3,457 points. That would have to be where my stop loss would have to be, because again, we've already looked at that's how much it fluctuates by. And if you're looking at some of the moves lower during the fluctuations, you can kind of see it is around 8%. Here we go. Look, that's a prime example right there for you. When you had a pullback in the markets back then, how much did it fluctuate by? Around 8%. So it really does work in your favor, guys, when you get these pullbacks in price. Again, markets pulled back here. How much did it fluctuate by in the pullback? Again, look, around 8%. It literally does work, guys. These volatility analysis is not, it's not just made up data. It really does work. This pullback here was around 10%, okay? So these ATR spreadsheets are really going to help you get into the market. So let's say, for an example, the point I'm trying to make is if you're buying a trending market and you got a pullback in price, of course you're going to jump in the market, for an example. But let's say you jumped in the market when it pulled back around halfway through. So let's say you had a pullback, but you knew the long-term outlook is positive for the stock market. You could have jumped in the market here and had your stop loss back here, for an example. And now your stop loss is protected. You have the 1 month volatility, giving the room for the market to fluctuate, and you're not worried about getting stopped off. That's why all my members in my service, we've been buying the SP 500 on the dips. I'm waiting for all these pullbacks. These pullbacks are perfect for me because the long-term outlook for the stock market is bullish because of the fiscal stimulus money coming into the US, the central bank pumping unprecedented amounts of money. It just drives up inflation, drives up growth, and that's positive for the stock markets, okay? So there's a prime example, guys, of how you can use these spreadsheets. I've been talking about Bitcoin for an example, okay? I'll give you a prime example here. Let's go into the crypto ATR spreadsheet. Bitcoin's average volatility for 1 month is around 35%. Let's call it 35%. Let's look at all the recent pullbacks in Bitcoin. 30%. 25%. See, guys, Bitcoin is literally pulling back by how much. The spreadsheet is telling you Bitcoin's pulling back, and this Bitcoin data is going back until 2011. There you go. So what's that? 10 years data. That's literally what data is telling you. And you can see how far that data is going back all the way to Feb 2016, okay? So it's using 10 years of data and it's going back for the past 5 years. And there's no surprise that when the markets do pull back, they're pulling back by this amount. So what am I trying to say? Let's say you jump into this trade, for an example, during a pullback. Even if you got into the market when it wasn't at the very bottom, but let's say you got in at this price here when it was close to where it bottomed, your stop loss of 30% would mean that you would never have got stopped out, even as it falled further in the markets, as a prime example. So that's why I'm just showing you guys how these ATR volatility spreadsheets will literally save your ass in the markets when you get into a trade from your stop loss being hit, okay? So that's really important for us to understand, all right? So most importantly, guys, when we're getting into the markets, what we want to look at is, okay, well, we now have the ATR volatility analysis. We know if we use these spreadsheets, if I'm looking at, for an example, whoops, sorry guys, apologies. If I'm looking at, for an example, the US dollar, for an example, right? If I'm looking at trading the euro against the USD, all right, fine. I know my stop loss needs to be 3.07% away from current price if I'm jumping into this buy trade. So I know if I'm buying euro USD, my stop loss has to be around 3.07%. Okay, so this has to be my stop loss. And then where does my take profit have to be in the markets if I'm using a 3-to-1 risk to reward? So it would be around 9% take profit target in the markets, all right? Remember, we have to use this risk to reward in our favor, guys. If we don't use risk to reward, we're going to get caught out and we're going to lose trades, and we don't want to be in that situation. We want to be making money, not losing money in the markets, all right? But how can I work this out accurately? Let's say you don't have access to a computer or a chart like this, and you don't have this measuring tool to tell you where to have your take profit target and your stop loss. If you don't have, for an example, or you don't use TradingView, you may not use this platform, for an example. This is where the spreadsheet I created for you is going to become your best friend, okay? Because in this spreadsheet I've created for you, which I'm going to show you now, in this volatility or this risk management spreadsheet, sorry, apologies. In this spreadsheet, I've set up, for an example, an automated way of knowing where to place your stop loss, where to place your take profit in the markets using a 3-to-1 risk to reward. And then you're going to take the data from the Atr Volatility spreadsheet, put it into this spreadsheet here, and it will automatically tell you, this way you can place your stop loss, this way you can place your take profit. And then you're going to put in here how much you want to risk per trade, and it's going to automatically calculate for you. You have to place this much on this trade for you to make sure you're only risking that percentage amount on a given position. So, hypothetical example, let's take Euro USD in the markets. All right, so Euro USD monthly ATR is 3.07%. That's how much the currency pair is fluctuating by if I'm buying or selling Euro USD. Let's say I want to buy the euro against a dollar. My expectation is the euro is going to go up in value against a dollar. I now know if I want to buy the market, I have to place a stop loss of 3.07% if I'm going to trade this over a 1-month window, okay? Using my 3-to-1 risk to reward. So that would basically mean I'm going to try to hold this trade for 3 months and hopefully it can hit my take profit target, okay? So what do? The 1-month ATR is 3.07%. We type in 3.07, all right? What's the current price in the market? The current price in the market at this moment in time for Euro USD is 1.19801. Okay, so let's get this back up. 1.19801. 1.19801. You put the price of Euro USD. Don't worry about the symbol at the top. You can change it if you want to, but that was just a previous example I had. So we got the price of the market. This is where we're trading right now for Euro USD. 1.19802. We place the ATR volatility stop loss of 3.7%. That's all you do. The units is basically telling you you're exchanging 11,980 units of the euro in exchange to buy $1.19801, okay? That is basically the unit size. I'm going to share a video of you just to understand that, but don't worry about that for now. You'll never ever have to adjust this unit column here. All you'll ever have to do is come into the spreadsheet, put the price of the exchange rate right now if you're trading currencies, place the ATR 1-month volatility stop loss, and then automatically it's going to tell you the stop loss has to be 368 pips from the current price to give you the 3.07% stop loss, okay? All right, guys, so that's really important for us to understand. Again, we put this here, 3.07%, okay? And then again, we come down here after and we put, again, 3.07% in this column, and it automatically times it by 3 using a 3-to-1 risk to reward in the markets. But if you want to change it, maybe you want to have a 5-to-1 risk to reward, you can change this to 5. So times it by 5 if you want to, okay? But I use a 3-to-1 risk to reward. And it's going to tell you now exactly how much you need to have your take profit target as a percentage to get that 3-to-1 risk to reward, okay? And now it's telling you our stop loss price of 1.16123. and our take profit price has to be 1.30835. So let's go and test this in the markets right now and see if this is accurate, because I don't want to just say this to you. I want to show you how this actually works. So again, all we've done, one more time, guys, we put the market price, we put the 1 month volatility stop loss. It's already told us where we have to, how many pips we have to place our stop loss. And it's told us that our stop loss in percentage terms, take profit, and it's calculated where we place our stop loss and our take profit price. So let's go in and do this for ourselves. So the stop loss is 3.07%. So from the current price, here we go, 3.07%, 367 points, 368 points. So bang on the money. The spreadsheet literally got that to the T right, how much we have to place our stop loss by in the markets. And it said our take profit target had to be 9.21%. So from the current price, 9.21%, 9.21%. And it was 1,102 points. And we get the exact same price in the markets. But look, what I'm trying to show you is this, guys. I just did the percentage move, right? But let's just look at the price. So let's say I came in here and I didn't have this and I didn't move it around myself. What price did it say we had to get into? Because remember, look, it automatically told us where to get in out of the market as a stop loss and where to take our take profit. So this is why I want to do it for you in a better way, okay? I was just showing you the percentage terms, but let me show you now in terms of me just automatically taking it like that and then just manually putting it in just as the spreadsheet told me to, okay? So let's say, for an example, we know the price of the market right now is 1.19821, as we can clearly see right here. That's the price of the market, 821. Okay, so we know our take profit target, it says here, is we can clearly see here, 1.30835. Okay, and our stop loss, as we can clearly see here, we can start to calculate this one now. So let's just say we just drag it down a tiny bit and now we edit 1.19824. That's the current price I'm putting in here. And the stop loss right here is saying 1.16123. And there we have it, guys. Look, the stop loss again is exactly where our stop loss is exactly where the spreadsheet was telling us it has to be in the markets. 1.16123. Here we go. 1.16123. And again, look, 3.9%. And that again, guys, is our stop loss area, 3.07%. Okay. Very similar, off by 0.2%. Okay. And then again, our take profit target is 0.21%. And again, 9.21%, and it's 9.19%. So again, guys, what I'm trying to show you is this spreadsheet, if you're trading currencies, will tell you automatically, there you have it, guys. That's where you place your stop loss. That's where you place your take profit target. Now, the last bit we need to look out for, but the most important thing for trading currencies is, okay, well then how much am I actually placing on the trade to make sure I do only lose a certain amount in my account per trade. So let's say again, our risk is only 5%. Let's say our account balance is 10,000 account, all right? Now, 5% of 10,000 is 500 pounds, okay? So if you had a 10,000 pound account, we only want to lose 5%. We can only afford to risk or lose, 500 pounds on that trade. That's 5% of our total balance. Now, if we now want to know how much we put on the position to make sure that we don't lose more than 500, the spreadsheet automatically tells you that you only have to place £1.36 on this trade to make sure you don't lose more than 500. And this is all calculating based on the stop loss. If you click on the value here, it's telling you, it's just basically dividing 500 by the stop loss, okay? And that's how you get your answer for £1.36. Because again, look, if you take £1.36, that's how much you're placing on the trade, and then the market goes against you by 500 points. Sorry, not 500 points. The market goes against you by 368 points. So 1.36 times 368, then we get exactly £500. So this spreadsheet, guys, it's all there for you. It's literally going to tell you what you need to know if you're trading currencies. It's going to show you when you get into the market. Every time you come into the spreadsheet, guys, it's going to do this for you if you're trading currencies. Come in the market, put the market price, put the average volatility stop loss in terms of percentages that you get from your ATR spreadsheet that came from right here. You put this 3.07% number in the spreadsheet, and it's going to tell you automatically how many pips your stop loss is going to be, and then it's going to calculate straight away your stop loss area price and your take profit price. And then you just come into here, you put your account balance, you put how much you want to risk on a single position, and then you literally automatically get told by the spreadsheet, you have to place on this trade £1.36 if you want to make sure that you give the market the 3.7% average volatility, which is 368 points. And that's going to mean that if it does go against you and you do lose a trade, don't worry about it. You're only going to lose your 5% risk that you have told yourself that you're only going to risk. And then if we get into the market and it's winning and the trades going in our favor, unless there's a fundamental change in the trend, then we must try hold the trade till at least we get that 3-to-1 risk to reward in the markets. The only reason we come out of the trade is if there's information in the markets that's telling us this trade may not play out as expected. But I know some of you guys, you may not be looking to, for an example, buy a currency pair. You could be looking to sell a currency pair. And here we have the sell set up, and all you do here is exactly the same. This calculation is just for selling a currency pair. So when you're selling a currency pair, you just come in and you do exactly the same thing and you get the same answer. However, guys, I know you're not always just going to trade currency. So what about if I'm looking to trade, let's say I'm looking to trade, I don't know, what's a good example? The S&P 500 again, okay? Just an example. Let's say you have now your account balance, you know how much you're going to risk per trade as a percentage, figure out what the stop loss is in terms of pips, and then you're going to get your trade value. So let's say, for an example, we're looking at the index. We know the dollar, we know the S&P 500 fluctuates by 8.4%. So we just go onto our chart. We look at the chart. We get our measuring tool. If you're on trading view, it's literally this measuring tool here. Price range, and we go down 8.4% from the current price. And it's telling us 1,188 points is how much this index moves if it's going to move by 8.2% from the current price. So 3,188 points. Okay. 3,188 points. So if I want to risk 5% per trade of this 20,000 account balance and the stop loss is 3,188, I can only risk on my trade 31 pence. That's how much I have to place on this trade. I can't place any more than 31 pence because 31 pence, because remember, 5% of, for an example, 20,000 is 1,000. So if I'm losing 5%, I'm losing 1,000 on this trade. And again, if I times spot 3.1 by 3,188, you're getting pretty much bang on the money 1,000. Okay, so I haven't been able to automate this side of this trade, this spreadsheet, the same way I did for the Forex. I have to do a bit of thinking to get to that stage. But again, you can literally go onto TradingView, draw down exactly how many points that is, put it into your spreadsheet, and you're going to know automatically that's how much you have to place on the trade. So if you're going into the market, guys, all you have to have at your disposal is 3 things: the volatility, how much you're risking per trade in terms of percentages, and then how many points that is from the current price. And you're going to get your a market analysis telling you exactly how much this market is fluctuating by. So guys, the reason I was showing you this is because I really want you to understand, guys, and I'm happy you guys came over. Please follow what I'm saying. Please put your stop losses using this ATR volatility stop loss. Please use risk management in terms of calculating your trade value based on how many points this asset fluctuates by, based on the volatility analysis, so you don't lose your hard-earned money. Don't do this day trading strategy that doesn't work, because you have to make sure the stop loss on day trading is at least the average volatility for a day. And then once you realize that you can't get the 3-to-1 risk to reward because it doesn't even move that much in a day, you're going to stop wasting your time trying to get rich quick off trading and doing this intraday trading strategy, which is just high risk, and you're really just gambling. Okay, I've done day trading in the past. Sometimes I even do day trading now and then if I think there's going to be a market move. But you know what? The truth is, I tell myself when I do day trading, I know that I'm gambling, and I know there's a high probability I could lose my money. So I have to be comfortable with saying to myself, well, cool, if I'm going to day trade, no problem. But I now know it's a 50-50 gamble whether I'm going to win or lose. And if I want to take that risk, so be it. If I don't want to take that risk, then I'm not going to do that. I'm going to punch my stop loss on a weekly basis. Sorry, 1 week ATR volatility basis, or again, on a 1 month volatility analysis. So guys, I hope that made sense. And I really want to answer any of your questions. So if you've got any questions, guys, please shoot ahead. Yeah, exactly. Euro USD is not an interesting trade currency pair to move. It doesn't fluctuate. The best currency pairs that move the most are commodity currencies in the markets. Commodity currencies move the most because their value is really dependent on the commodity exports. And as you've seen, oil is very volatile. So here, for an example, guys, look, we've got oil here. We've got an oil analysis. So you've got crude oil prices here. So if you're trading oil, for an example, I would highly recommend you never try to use your ATR volatility on a weekly basis. Oil is too volatile. But let's say you're going to trade oil. Let's have a 28% stop loss, for an example. I've done weekly trades on oil before. We made some really good oil profits recently, to be honest with you. But I was so confident it was going to go higher. But let's say I do trade oil. I have to make sure that my stop loss from the current price, again, is at least 28%, at least. All right. So let's say that around 28%. That's gonna have to be your stop losses, guys. And you're gonna now know 20% is around 1,927 points. So again, if you go to our risk management spreadsheet, 1,927 points. That's where it has to be our stop loss. And again, if we're risking 5%, we can only take half, we can only bet on this trade half a pence or half a cent. Otherwise, if you want to trade more to make more money, you can, but you have to take more risk. You have to risk 10% of your account on a single trade. And as we looked at earlier, guys, if you're going to risk 10% on your trade, then we know the risk of 10%, meaning, yeah, it's going to take 10 trades when you're out the game. So, you know, it's totally up to you how you want to play that risk, guys. But again, the risk is real in the markets. So guys, please go ahead and ask me questions. If you've got anything you want to know, I'll be more than happy to answer your questions. 1 second, let me just get this question up. When you get the amount value, when you get the amount you're risking on a trade, how do you calculate the pit value? As I've shown you guys, I've already gone through that with you. So how do you get the pit value? I've already shown you guys on the spreadsheet. It's all here for you. It's there. Pit value is here. It calculates it for you. All you have to do is put in your account balance, how much you want to risk per trade, and it automatically calculates the pit value for you as long as you put the market price of, for an example, the currency, the 1 month ATR, and then it's going to calculate how much you have to place on the trade based on the amount of pips that it moves on a daily basis. Or again, here, as I showed you guys, all you have to do here is put your account balance, how much you're risking per trade, And then you have to go yourself manually if you're trading anything else apart from currencies. You're gonna have to just look at using that measuring tool. How many pips is it? Put the pips here. Automatically, it's gonna tell you that's how much you're placing on a trade. Yeah, so if you're trading lot sizes, it's really simple. Apologies. All right, so if you're trading lot sizes, just remember, okay, so one lot, what's it doing that? One lot is 1.00 on your brokerage platform. Hold on, let me just do this for you so you guys know. And let me keep this on this. I'm actually gonna save this on a spreadsheet for you. Okay, one lot is 1.00, and that is equal a lot of the time to $10 per point. That's what one lot is, okay? One mini lot is 0.1, and that is equal to, $1 per point, okay? Yeah, then you got one nano lot, don't you, right? And then you got, okay, and that is equal to 10 cents per trade. One lot, one mini lot. Yeah, I can't remember the other one top of my head. Sorry, my head's gone a bit blank. But most importantly, just understand, this is going from 10 pence all the way up to 90 pence, okay? So if you're gonna trade 90 pence on a trade, then obviously that's gonna be equal to that many mini lots. Sorry, not mini lots. I can't remember my mind's on completely blank at this moment in time. Sorry, guys. Someone remind me. Yes, micro lot. Sorry, thank you. Sorry, my mind went so blank for a second. Yeah, so one micro lot is equal to 10 cents, okay? So every time you put into your trading account, if you want to put 10 pence, you're just going 0.01. If my calculation tells me I'm trading 52 pence, then obviously I'm going to go 0.05 because that's equal to 50, for an example. Unfortunately, you can't do 52 like that. The lowest you can do is 5, so just you do 50. Then obviously it goes up to 9, and that's equal to 90 cents on a trade. And then when you go to $1, it then goes from 9, and then it goes up to 1. And now 1 is equal to $1. So let's say, for an example, hypothetically thinking, let's say the stop loss on the euro dollar was 158 points, and it said I can trade $2.79 per trade. Then obviously when I'm doing this, I'm doing it like that in my mini lot, and that is equal to 2.90. That's literally how it works, okay, guys? And obviously, if I'm at, let's say hypothetically, I'm doing £9.90 for an example, in my brokerage platform. When you put 0.99, that is literally meaning you're trading $9.90. And then when you get to $10 per point, then you get into one lot, which is 1.00, and that's equal to 10. Okay, really easy, guys. Not difficult to understand. Okay, just look at it in terms of pence, pounds, and tens. Okay, it's quite simple mathematics. Yeah, guys. So next, I want to show you one thing. I haven't finished yet. I just wanted to touch on some things with you guys. Now I want to touch on how do you update these spreadsheets. Okay, so for an example, crude oil analysis. You go to the links. Okay, you go to the links. You click on Brent crude oil. It opens up the spreadsheet. It opens up this historical data on investing.com. You go to the daily, or you go to the weekly, you go to the monthly. I was on all these spreadsheets. I've done timeframes of 10 years. So I go to the calendar here, and when it says start date, I just go back 10 years. So 2011 from this exact date. Look, same date, go back to 2011. You press apply. It loads up the data for an example. And now you're going to have data for daily historical volatility of Brent crude oil on the daily charts over weekly timeframes, and over monthly time frame. So just choose your time frame. So let's say I want to choose monthly time frame. I press download. The data downloads. You don't want to keep the column F. Get rid of the volume for some of the downloads. Get rid of the volume, highlight all the rest, press Control, Command down, highlight all the data, press C for copy, go over to the Brent crude oil monthly chart because we just downloaded the monthly data. And then literally you're going to come into the first column A and you're going to press paste. And now it's updated the spreadsheet for you, automatically done. That's all you do, guys, okay? So that's like, for an example, for crude oil that I've done. And again, you'll have the links in each spreadsheet. When it comes to the currencies, guys, so let me give you an example. When it's come to so for the indices, again, sorry, guys, let me show you this. So for indices, the links are all here. Here you go. Here's the links to get all the indices, historical data. You literally do exactly the same thing, for an example. If you're trying to update the S&P 500's volatility, again, you just come here, the spreadsheet opens, you get all the data here, you go to historical data, click on historical data, as it shows you here. And then again, exactly what I just said, take the time frame out 10 years, using the calendar, press apply, and whatever time frame you're downloading, download it. If you want to change from a daily data to weekly data, just click on weekly and it will adjust, and then you download it, and then you literally paste it into your spreadsheets as I showed you. When it's coming to downloading these currency ones, guys, just so you know, when it comes to downloading currencies, the link is here. Click on the link. I've only included one link, and the reason I've done that is because to get any currency pair in the markets, all you do is come in here and you just change the symbol. So let's say I'm going to get the pound against the dollar. I just type in the base currency pound. I change this to USD. And then look, it literally just automatically takes up the pound against the dollar. You can change this to any currency pair. I mean, I could look at, for an example, the South African rand against the Russian ruble, for an example. It doesn't really matter. The data is going to be there and you can download it straight away. Look, it's all there for you. All right. And then when you're looking at the spreadsheets, guys, all the data is going to be there for you to download. Same for metals. So looking at gold, looking at copper, I've literally got all of it there for you guys. The links are there. Just go download the data for yourself. And it's easy for you to do. Okay. Now, where do you download these spreadsheets, guys? Obviously, you're probably thinking, well, where do I get these spreadsheets from? Well, that's not to worry, because let me just save all this for you guys. Here is the link, guys. I want to show you the link. kainsmarkets.com/webinar. Here you go. Go onto this right now, guys, and download it. It's all there for you. There you go. There's the link. Go download the spreadsheets. It's all there for you guys. Now you know how to implement this. Download the ATRs. It's got all the ATRs, commodities, it's got currency, it's got stock markets, and it's got crypto there for you. Okay, entry strategy. Obviously, you have to do technical analysis. Okay, guys, that's really important in the markets. All right, guys, if you've got any questions, quickly ask me, because I've got to jump off now. I've got stuff to do. All right, guys, peace and love, man. I hope you enjoyed this webinar. I hope I was able to help you and serve you and help you in some way in the future. And I hope you never blow your trading account if you follow this, because you won't. And you'll be a happy, happy trader. All right, guys. Also, I'm going to record this actually. So if you want to get the recorded version, send me a message and I'll send you the recorded version. I'm going to upload it onto my YouTube. It'll be up there in a few hours. All right, guys. Take care.